the committee needs to put on some more serious winter gear. If you put it in, what form of winter gear you?
So I've been talking about this, since the beginning of the year. I think that we have, the committee has announced its intention to keep the Fed funds rate extraordinarily low, at least until the unemployment rate falls below 6.5%. I see that as a commitment really to keep interest rates low until unemployment has fallen that far. We could provide additional stimulus to the economy by lowering that threshold from 6.5% down to 5.5%. That would provide even more of a guarantee in terms of how long interest rates are going to remain. That will push downward further on real interest rates and provide more stimulus to demand.
But you're not pushing for increasing the scale of the current asset purchase program?
I think that the current asset purchase program is complicated to use as a tool, as we hear, because we have to become a lot more clear about what exactly are the metrics associated with that. We have this term substantial labor market outlook, and substantial improvement in the labor market outlook, I should say. And different people seem to be interpreting that differently, both in the public and then among communicators from the committee about that. I think we've really solved a lot of problems in terms of the Fed funds rate by being much more explicit about the markers for that. And I feel more confident in that ability of that tool to provide the requisite stimulus because we've been so clear about it. So I like the idea of just lowering that threshold.
You talked about lowering the threshold to 5.5%. So obviously you're a big fan of lower for longer. Will it take 5 to 10 years to get to 5.5%? Is that what you're saying, or why would the interest rate need to be low for even longer than 5%?
So I should have been clear about this in my talk. I'm not saying that interest rates will remain at zero for 5 to 10 years. Absolutely not. What I am saying is that interest rates may not be returning to their 2007 levels over that 5 to 10 year period. So that's more the distinction I would like to draw.
In the speech, you talked about the idea of over this horizon, market imbalances or threats of bubbles might be sort of following the economy along through all that. Do you see any signs of imbalance right now? Are any markets out of whack? Do you see any bubbles, clear bubbles out there right now?
I think the term clear bubble is with respect to contradiction terms. Right now, I'll say a couple of things about that. I don't see those kinds of risks out there. But I think the more important question is, do those risks bulk large enough in my mind to warrant taking monetary policy action to do something about them? When it comes right down to it, for me as a policymaker, it's really about how is this influencing my decision? Is it big enough to a risk that I'm forestalling, and is my action going to be effective enough by, say, raising rates or tapering purchases? Is it effective enough at mitigating that risk to warrant the loss of jobs and the disinflationary pressures? And the answer is absolutely not at this stage.
But how confident are you in the Fed's ability to identify those risks when in 2007, it missed some of the biggest risks of all?
So, I think there's I'll say a couple things about that. I mean, there's a presumption in that question, which is that which I think confuses the ex ante versus the ex post, meaning that we had a bad outcome. There's no doubt about that. Should the probability assessment of that bad outcome as of early 2007 been a lot higher? Those are two different statements, right? I mean, bad things happen all the time. That doesn't mean that we should know that the probabilities of them happening were necessarily higher than we thought. So that's maybe more philosophical question. I think that in terms of what we're doing in 2013 relative to what we're doing in 2007 is just dramatically different, as I talked about. We just have a lot more surveillance in place, monitoring what's going on in the financial system, a lot more attention trying to focus on this issue of how do these financial system risks morph into macroeconomic risks into the dangers to our being able to fulfill our dual mandate of price stability and max employment. There's a lot of thinking going on about that latter connection, and then a lot of monitoring going on about what's going on in the financial system. So I think just a lot of reasons for people to feel confident that we have a better understanding of what's going on.
Some commentators make the point that you've really created a very, very large wealth effect, and you're talking about getting stimulus in the real economy. Do you talk about that, and do you see the transmission effect from basically the stock market to something now more real, or is that part of that 10-year horizon?
You know, certainly when you push downward on long-term real interest rates, as the Fed's actions are designed to do, that pushes up on the price of all long-lived assets. That's going to push up somewhat on stock prices. It's going to push somewhat up on home prices. You know, any long-lived asset's going to be, and that makes net worth go up, and that's a positive for the economy. So it's definitely a channel of stimulus, I think. You know, I think one of the difficulties in this recovery has been that the real hit to net worth among households, and you don't get that. So if the Fed does what's called the survey of consumer finances, where it's looking across households, and the sample of households, you're actually getting into the micro data as opposed to just looking at the macro averages. So the macro data tells you that the average net worth declined. Looking at this micro data tells you that the median net worth declined, meaning if you rank households from net worth from top to bottom and look at the middle one, that household went back to the early 90s in terms of median net worth, as from 2007 to 2010. So that's a huge damper on demand, huge damper on demand.
There's this concern you spoke about, and a lot of people in the room seem to have spoken as well in the questions about the risks of creating financial instability. And you are asking for the Fed to do more, and I think what some of the people in there and some of the people that are commenting are saying is that maybe there's a diminishing return to how much more you can do as the Fed by pushing down rates or by increasing asset purchases, and that maybe the rate of stimulus that you can provide is less proportionate than the risk that you're creating, if that makes sense. What do you think?
That's a very nice way to put it, I think. And you know, I think that whenever you take a step in terms of monetary policy, you're going to have to be asking these kinds of questions. That's the probabilistic cost-benefit calculation I talked about, whether you're talking about taking out accommodation or adding accommodation. And you know, for myself at this stage, I would respectfully disagree with the commentators who see that as being an issue. I think that we are able to provide stimulus through our actions, and I think that the chain of connections through which the worry about financial stability is still so tenuous that I wouldn't want to be robbing the needed stimulus to the economy on that basis, if that's making sense to you.
You decide to use rates to combat this financial stability situation, you're still falling short on your mandates. You know, what does that mean for Fed credibility?
I think that's going to be a part of the question you'd have to ask yourself if you really went down that path would be, what does it mean for the commitment to your objectives? With that said, you know, if you came to that point in time, which we're not at, but if you did come to that point in time, you'd have to be saying that we are raising rates. That's going to mean a loss of employment and downward pressures on prices. On the other hand, what we're doing is forestalling the risk of an even larger fall in prices, I mean, an even larger fall in employment. So you're still talking through the dual mandates, but it would be, don't get me wrong, that would be a challenging conversation to have.
That's a consideration, Fed credibility as an overarching idea.
I think it's a question about how you're communicating about your objectives, right? If you're always communicating, as I tend to do and others tend to do, in terms of your modal outlook, and you don't talk much about tail events, and then you suddenly show up and say, hey, we're tightening policy because we're worried about tail risks, that's going to be a problem. If you start to talk about tail risks more as part of your natural discussion of policy, then I think that credibility issue can be mitigated to a certain extent. But it would be a challenge. It would be a challenge.
Don't you think the Fed also has a mandate for financial stability? I mean, isn't that literally the preamble of the Dodd-Frank Act, that regulators now have to be concerned about financial stability, and you can't just say, well, that's a tail risk?
Oh, I want to separate two things. I mean, I think the regulators have been given a very key task in order to protect the economy against the kinds of risks that we saw in 2007 and materialized in 2007. And the kind of environment that I sketched, the low real interest rate environment, that I see as quite possible over the next 5 to 10 years will put even more pressure on that regulatory framework. But I talk about our mandate, I'm talking about the mandate of the Federal Market Committee to make monetary policy. And that is very clearly articulated in the Federal Reserve Act as being promoting maximum employment, promoting price stability, and moderate interest rates, long-term interest rates. So it's really about, when we talk about monetary policy, it's about promoting price stability, promoting maximum employment. But that isn't, the Federal Reserve is a big institution, it has obligations well beyond monetary policy, and absolutely, keeping the financial system stable is absolutely a job through the regulatory and supervisory apparatus.
Your colleague Jim Lord yesterday talked about if inflation were to cool further from where it is, at some point he could envision, if it continued to ebb, he could see ramping up bond purchases. Where do you sit on that one?
Right now my outlook for inflation is it's below target over the next 2 years. That's part of the reason why I've been calling for more accommodation. I think that I have not changed my outlook yet for inflation. Certainly, I'm watching some of the same markers that you said Jim is looking at, but I haven't changed my outlook yet. Certainly, it's definitely a cause for concern. Let me try to be a little more try to articulate why I feel this is a concern. The Fed's mandate to keep inflation at 2% is to protect borrowers and lenders when they write contracts with one another. When I write as a lender, when I'm saying to people, I'm giving $1 up today, I'm going to get dollars in the future. I want to know what those dollars are going to buy. I want to make sure the Fed doesn't run too high an inflation rate as a lender. As a borrower, if the Fed ends up delivering too little inflation relative to what it promises, you're forcing that borrower to repay in more expensive dollars, give up more goods in exchange than they had anticipated when signing that contract. So I think that it's very important for us to protect the target both from above, which gets so much attention, but from below as well.
How do you factor what Japan is doing into your calculations? It seems that the easing and the outflow is driving rates down here to some extent and helping you perhaps with a low rate policy, or what's the...
I think about Japan as being a source of demand for U.S. Goods and services, and there's still some uncertainties about how effective their policies are going to be, but to the extent they're successful, it's a good thing from our point of view. It's going to be improve the outlook for employment, improve the outlook for prices. No matter what we're doing with our policy instrument, you're going to get a better outlook in both dimensions. So I'll say I'm very hopeful that they're able to achieve the better outcomes that they're looking for.
But is there a financial outflow also reducing interest rate policy here for you, making it less necessary for you to be?
I think, as I said, I typically think about it more through what's going on the goods and services side.
There's a question about how direct the different channels through which you can stimulate an economy work. You got the fiscal channel seems to be the most direct. Within the Fed, you have interest rates, and then once they're at zero, you can use the forward guidance, and then you can use asset purchases. It's kind of within the room today, and I think yesterday you could see that people at some point were disappointed that the Fed seems like there's a transmission channel thing that they talk a lot about in Europe, how it doesn't seem to be working that much. For example, the banks having so many reserves and tight lending standards, so they're not lending out. You're asking to do more, but on the apparently most indirect channel, which and I might be wrong. You might disagree with me, but first of all, why are the Fed's policies apparently not transmitting in all that way, and why are cash reserves so high where companies are hiring? And second, is the channel that you're speaking of less direct, yes or no, and why?
Oh, so I think you're sketching a very new conventional wisdom if that's what it is. I mean, I think that the general I think sentiment was that monetary policy was the tool by which to do stabilization policy. I think the challenge for monetary policy has been what's called the zero lower bound, that we're not able to make interest rates lower than they are. As I said, if interest rates were at 3%, the Fed funds rate was at 3%. I had the outlook I have under that and given that policy stance, I'd cut interest rates, and that would. I don't think we'd be sitting around talking about how ineffective or effective that would be. Everyone would agree. Yeah, that's going to be. That seems like the right response to that situation. I think. I'll say two things about the effectiveness question. I think the signs of ineffectiveness have come from the fact that we're facing the zero lower bound, which is made. The policy tools we're using are substitutes for our usual policy tools, but they're imperfect substitutes in the sense that if interest rates were at 3, I'd be cutting interest rates. I wouldn't be saying we should be buying more purchases, and I wouldn't be saying that I wouldn't be talking so much about forward guidance. I'd be talking about what to do with interest rates. So in terms of what we talk, why do people see this as not as effective? It's because we would like, I think everyone would like to see the growth outcomes be better than they are. The right question, though, to be asking is, suppose we weren't doing what we're doing, the Fed wasn't doing what we were doing, would things be better or worse? And I would say, if we had interest rates, we raised interest rates by 200 basis points, I think things would be a lot worse than they are right now. Why don't we talk about the other tools? They're not our job. It's what I try to articulate when I was asked this question by the audience, is that there are things that I have that's in my purview as a policymaker, and I talk about those. Some would say too much, but that's what I talk about.
Going back to QE, you said that you would be in favor of more clear metrics around when to begin scaling back, et cetera. What is preventing the committee from coming to consensus around more specific metrics?
That's a good question, and I don't fully. I would say I don't really know the answer to that. I think to me it seems that it would clear to me that it would be very helpful to provide those kinds of metrics.
And do you have specific metrics that you would favor?
I think it's. I do, but I think it will clutter the conversation, create more of the uncertainty that I'm trying to avoid by talking about those. So I'd rather that we were able to come together as a committee and talk that through.
You talked a lot about supervision. I'm not sure I know where you kind of stand on the too big to fail side of things. There's this sort of Richard Fisher camp, let's forcibly break up these banks, and there's the other camp, Tarullo, Dudley, et cetera, that want to work through Dodd-Frank. This is obviously a big part of the speech you gave, financial stability.
Yeah, so there's good questions. We have a long tradition, the Federal Reserve Bank of Minneapolis, on working on too big to fail. My predecessor, Gary Stern, co-authored a book called Too Big to Fail with my current head of supervision, Ron Feldman, back in 2004, pointing out some of the peculiar incentives that banks are provided through having this kind of safety net. I think that I think very positive steps were made through Dodd-Frank. How positive? I think we have to have a way to gauge. We have to have a way to measure. So we should be measuring on an ongoing basis how big is this subsidy that we're providing to the banks. We're doing some work on that, trying to get those metrics developed in Minneapolis, that Andrew Haldane at the Bank of England has done some very nice work on trying to measure these subsidies. What we want to see is, Dodd-Frank says it's going to end too big to fail. Okay, well, let's go out and see, is it ending too big to fail? I think we should give it a little bit of time before declaring it a failure. We're still unrolling all the apparatus associated with it. There are good steps in it. I think raising capital for systemically important institutions, having the Financial Stability Oversight Council, which can figure out things that may not have seemed systemically important, designated them as systemically important. And then the resolution planning side, I think that's another real positive. Will these things work? I think that's what we have to keep measuring, and keeping track of the subsidy is the right way to proceed on that. Yeah, so that's where I don't know which camp you want to put me in as a result of that, but that's sort of the way I feel about it.
You mentioned Haldane, and he wants simpler rules, right? He doesn't like.
Yeah, that I don't necessarily want to associate myself with that position. I found his remarks really interesting in Jackson Hole. I thought the analogy was very, very catchy and something I hadn't thought about before. So I thought that was very intriguing. But I'm pointing to specifically is the metrics that he's using. I find those interesting. I think those would be useful to be able to replicate and continue.
So it sounds like it's too early to declare that Dodd-Frank approach
Oh, yeah, no, the Dodd-Frank approach is still being unfurled, so, and unrolled. You know, we're not 3 years into the, since the act has been passed, so I think it's too early to make those kinds of judgments.
I wanted to get a little bit of clarification on this inflation comment. I mean, what is it that gives you confidence that inflation is going to kind of trend back toward target? Because in fact, commodity prices are down, inflation expectations are down, all the inflation measures have been on the soft side. So where's the confidence come from that the way it looked 3 months ago is still the way it looks more or less today?
You know, these are forecasts, and forecasts could certainly prove to be incorrect. But you know, I think given the stimulus we're providing, given the growth that I see in the economy, 2.5% in 2013, 3% in terms of real GDP growth, 2.5% in 2013, 3% in 2014. That kind of growth I see as being sufficient to put upward pressure on inflation. But you know, the outlooks are evolving based on new information at all times, Josh, and so it's something I'm certainly keeping a close eye on and monitoring.
Is there any inflation measure that would give you particular pause if you saw it reach a certain level that you would think of what you think policy should do?
Yeah, I mean, I'm sort of, I guess the answer to that is I'm in favor of more accommodations. So, and Josh was asking me about softening. That would make me even more in favor of more accommodations. So, you know, I think if you started to see upward pressures it's the other side that I think you often would worry about. Is there something that would make my outlook go above the 2.5% trigger? You know, you'd have to see something pretty significant in core before I would start to worry about that. It'd have to be much higher than what we're seeing right now.
But I'm talking about like in terms of ebbing.
Oh, the ebbing. You know, I watch core inflation pretty carefully. Watch a variety of the Cleveland Fed does, and the Dallas Fed does, to sort of have different measures of underlying inflation. You know, it's just one of those things where you don't want to be too hung up on what's happened in the last 3 to 6 months. You've got to be seeing what's going on. So it's just figuring. It's a judgment process more than anything else.